You know what I love about the internet? Every single time I post about dividend stocks, someone crawls out from behind their keyboard to educate me about basic math. But here's the thing that's going to blow your mind. The smart money just got absolutely crushed in 2025. While they were busy chasing AI stocks and growth darlings, the boring dividend companies delivered returns that would make any growth investor jealous. And I've got the receipts. Fresh data that's going to completely flip everything you think you know about building wealth. But first, let me show you the comments I get every single day. The hate mail that proves my point. Dividends are for boomers who don't understand modern investing. You're literally throwing away tax efficiency. Smart money doesn't waste time with dividend yield. They buy growth. And my personal favorite? Warren Buffett doesn't even pay dividends, so why should you care? Here's what kills me about these arguments. They're all based on this fantasy world where investing is some perfectly controlled laboratory experiment, where you can just ignore human psychology, market crashes, and the fact that most people panic sell at exactly the wrong time. Spoiler alert, that world doesn't exist. And I'm about to show you proof that'll make the growth-only crowd very, very uncomfortable. But before I reveal the shocking performance numbers from 2025, let me destroy their favorite myth. The tax efficiency lie they keep repeating. Growth stocks are better because you don't pay taxes until you sell. This sounds brilliant until you actually run the numbers. Qualified dividends get taxed at the exact same rates as long-term capital gains, 0%, 15%, or 20% based on your income level. So this whole tax drag argument, it's fighting a battle from 2003. But here's where it gets really interesting. When you sell shares for income, you pay taxes on the entire gain immediately. With dividends, you're only taxed on the dividend payment while preserving your cost basis. The math isn't even close, and I'm going to show you exactly why in just a minute. But first, remember how I said the smart money got crushed? Here's the data that's going to shock you. The 2025 performance massacre nobody's talking about. Ready for this? Coca-Cola is up 15.53% year-to-date, while Apple is down 21.31%. Let that sink in for a minute. The boring dividend king with 62 consecutive years of increases is absolutely demolishing the tech darling that everyone said was the future. McDonald's is up 10.32% while maintaining 49 straight years of dividend growth. Meanwhile, Apple, despite having a dividend itself, is getting hammered as investors realize that AI spending might not pay off after all. This isn't some cherry-picked example. This is 2025 reality slapping the growth crowd in the face. But wait, it gets worse for them. The $108 billion buyback disaster. Remember when everyone said buybacks were superior to dividends? Same money, better taxes. Let me introduce you to Intel. Over the past 15 years, Intel has spent $108 billion on buybacks. Their entire market cap today? $92 billion. Think about that for a second. Shareholders would literally be better off if Intel had never bought back a single share, ever. From 2018 to 2022 alone, they blew $28 billion buying shares around $50 to $60 each. Today's price? $22.55. They essentially lit $15+ billion of shareholder money on fire. And Intel isn't the only one. Meta destroyed $44.5 billion in 2021, buying at $354 per share. IBM wasted $201 billion over 25 years while their business crumbled. But here's what really pisses me off about the buyback cheerleaders. The growth stock graveyard. Growth companies create more wealth long-term, really. Let's take a walk through the growth stock graveyard. Roku, peak price. July 2021, $479.50. Today, around $80. That's an 83.2% decline. Peloton, down 96.2% from its pandemic. Peak of $167.42 to around $6.37 today. Remember when these were the companies of the future? Meanwhile, Coca-Cola just keeps chugging along, delivering consistent returns and growing dividends for 62 straight years. Johnson & Johnson just announced its 63rd consecutive year of dividend increases. Microsoft combines 20 years of dividend growth with actual sustainable business expansion. Here's what the growth-only crowd doesn't want to admit. Most growth stocks fail spectacularly. For every success story, there are dozens of Roku and Peloton disasters. The companies still paying and growing dividends? They're the survivors. But let me show you something even more compelling. The ETF battle that exposes everything. QQQ, growth, versus SCHD, dividends, versus VOO, Broad market. Over 5 years, QQQ wins with 17.76% annual returns. The growth crowd loves pointing this out. But here's what they conveniently ignore. QQQ's maximum drawdown since inception, 82.98%. SCHD's maximum drawdown, 33.37%. Which strategy can you actually stick with for 30 years? During the 2022 bear market, both SCHD and VOO had similar downside protection. But QQQ's volatility means you're on an emotional roller coaster that destroys most investors. And get this, in 2025, SCHD declined 1.39% despite being defensive, while QQQ managed modest 3 to 4% gains. The performance gap isn't as dramatic as the hype suggests, but here's where the rubber really meets the road, the retirement nightmare scenario. Picture yourself at 65 with a $2 million portfolio. You need $80,000 annually to live. Strategy 1. The growth portfolio. Market's up 20%? Great, sell 80K worth. Market crashes 30%? Now you need to sell 114K worth to get your 80K. You're literally playing Russian roulette with your grocery money. Strategy 2. The dividend portfolio. Market up, down, sideways? Doesn't matter. Your 80K in dividend income shows up every year like clockwork. From companies like Microsoft with its $458.17 stock price and $3.64 trillion market cap. J&J with its 808 credit rating and 63-year streak. McDonald's approaching 50 years of increases. Which strategy lets you sleep at night? But there's an even bigger risk most people never consider. The sequence risk that destroys retirement dreams. Early retirement is the dream, right? Financial independence, escape the rat race. Here's the nightmare scenario they don't warn you about. You retire at 50 with $1.5 million in growth stocks. First 2 years of retirement, market crashes 40%. With the sell shares strategy, you're now forced to liquidate assets at the worst possible time. Your portfolio gets decimated not just by the crash, but by the forced selling. You might never recover. The dividend portfolio? Those payments keep coming. J&J's 63-year streak doesn't stop because the market's having a tantrum. Coca-Cola's 62-year run continues regardless of CNBC headlines. When the market bounces back, you still have all your shares to participate in the recovery. And here's the number that's going to blow your mind. The $95.8 million secret. Since 1930, dividends have contributed 31% of the S&P 500's total return. Not 3%, not 13%, 31%. $10,000 invested in 1930 with reinvested dividends. $95.8 million. Same $10,000 without dividends. $2.8 million. That's not a rounding error. That's generational wealth. During the lost decade of 2010 when stocks went nowhere, dividends provided the only positive returns. During the inflationary 1970s, dividends were 73% of total returns. But sure, let's ignore them because they're old school. Now here's the psychological advantage nobody talks about. The emotional advantage that changes everything. You know what really separates successful investors from everyone else? Staying in the game. Studies show the average investor earns 3 to 4% annually, while the market returns 10%. Why? Emotional decisions, panic selling, chasing trends. Now imagine getting a dividend check every quarter during a market crash. While your growth stocks are down 50%, Coca-Cola still sends you money. Johnson & Johnson still pays you to own their stock. That quarterly reminder that you own pieces of profitable businesses, it keeps you sane during the insanity. It's the difference between panicking and staying calm. But here's what really separates the wheat from the chaff. The quality filter in disguise. Companies that can pay and consistently grow dividends for decades aren't average companies. They're the exceptional ones. Microsoft has increased its dividend for 20 consecutive years while building a cloud empire generating massive cash flow. Apple has grown its dividend since 2012 despite this year's 21% decline because the underlying business prints money. J&J just raised its dividend 4.8% for the 63rd straight year. Growing a dividend every year for 25-plus years requires exceptional business models, disciplined management, consistent cash generation, financial strength through multiple cycles. It's a quality filter disguised as an income strategy. But I need to warn you about one major trap, the yield trap that destroys wealth. Not all dividend stocks are created equal. AT&T just taught us a brutal lesson. The company slashed its dividend 46.6% from $2.08 to $1.11 annually, ending a 36-year streak. That juicy 5.9% yield looked attractive until they destroyed shareholder value with the cut. This is why you focus on dividend growth, not just dividend yield. J&J's consistent 4 to 5% annual increases. Coca-Cola's 62 years of reliability. McDonald's approaching 50 years of growth. These companies have proven they can grow their cash flow enough to support rising payments decade after decade. So, what's the bottom line here? The false choice. That's costing you money. Look, I own growth stocks, Microsoft, Apple, even some QQQ exposure. But this idea that you have to choose between growth and income? It's complete nonsense. The best companies do both. They grow their businesses and reward shareholders with rising dividends. Microsoft's dividend has grown 10.35% annually over 5 years while building a $364 trillion empire. Apple may be down 21% this year, but they're still increasing dividends while generating $95+ billion in annual cash flow. These aren't dying companies returning capital because they're out of ideas. They're compounding machines with the confidence to share the wealth. My challenge to the critics. Here's my challenge to the anti-dividend crowd. Show me a retiree who regrets having too much dividend income. Show me someone who wishes their portfolio generated less cash flow. Show me an investor who's upset about receiving quarterly payments from Johnson & Johnson, Coca-Cola, and Microsoft. You can't. Because they don't exist. Dividend investing isn't about maximizing returns at any cost. It's about building sustainable wealth that works in the real world with real emotions and real market crashes. It's about creating an income stream that grows over time, completely independent of market sentiment or talking heads on CNBC. It's about owning pieces of businesses so financially strong they can afford to pay you while they grow. That's not old school. That's timeless. The critics can keep chasing the next meme stock or AI bubble. I'll keep collecting my checks from companies that have been profitable since before the internet existed, and sleeping like a baby while I do it. Your next move. So what's your take? Are you ready to stop gambling with your financial future and start building real, sustainable wealth? The choice is yours. You can keep riding the emotional roller coaster of growth-only investing. Or you can join the ranks of investors who've discovered the power of dividend growth investing. Companies that pay you to own them. Businesses that have survived multiple recessions, market crashes, and economic upheavals while continuing to send checks to their shareholders. If you want to learn exactly how to build a dividend portfolio that could replace your salary and fund your financial independence, check out the link below. Because at the end of the day, financial freedom isn't about having the highest returns on paper. It's about never having to worry about money again. And there's no better feeling than getting paid just for being patient.